Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us. Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Netwealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research. Part of my role at Netwealth is to manage and govern the investments that we make available to you through the Netwealth investment platforms. And today I'm very fortunate to have a lot of ongoing interaction with the fund managers. Today we have Chris Joye, founder, Chief Investment Officer and Portfolio Manager at Coolabah Investments. And Chris is also a contributing editor with the Australian Financial Review. Welcome, Chris, and we appreciate your time this morning.
Thank you for having me on the show, Paul.
Coolabah have a number of managed funds available on our investment menus across super and IDPS, covering various Australian fixed interest strategies. We're fortunate to have Chris with us today, and given you manage Australian fixed interest strategies, thought we would focus on the Australian economy and the Australian fixed interest markets. I guess I'm now finding working from home almost business as usual, but how are you and the Coolabah team coping with working from home?
Yeah, mate, we actually have a large team, 23 executives, and that includes 11 analysts and 4 portfolio managers. And we have 3 offices, 1 in Melbourne, 2 in Sydney. So we've always actually been quite networked and disaggregated, and I've actively accommodated remote working capabilities. So this has not really been much of an adjustment for us. I work remotely quite a lot myself, notwithstanding that I might speak to the portfolio managers, up to 15 to 20 times a day. So yeah, mate, it's been fine.
Maybe a bit more of adjustment process for our families, I might add there. COVID-19 really is a human tragedy first and foremost, but it's having a significant impact on the global economy. Coolabah have been very prominent in your views on the number of Australians infected by COVID-19. So what's your forecasting model indicating now in terms of infection rates across Australia?
Well, just taking a step back, Paul, in January when the outbreak first publicly emerged, we didn't have a strong, emphatic view one way or another whether it would become a global pandemic. And we've seen counterfactuals around the world where countries have successfully contained the virus very effectively. We've seen that here in Australia, in New Zealand, in Taiwan, Hong Kong, and some other nations. So we've always been very data-driven and data-dependent, and we built quite sophisticated data science systems that real-time or automatically tracked every infection for every state, province and country in the world and every fatality globally. We then did a lot of analysis on those numbers to understand the evolution of the pandemic and form a view in February that this would go global. At that time, we also started building very sophisticated COVID-19 forecasting models. And in March, we published a very contrarian view that the number of new infections would peak in Europe, the US and Australia in early April. Now, this was at a time when epidemiologists were arguing that the peak in new infections might not occur until June or July. The Prime Minister was talking about a 6-month hibernation of businesses of at least half a year, that is. And so the outlook was incredibly gloomy. That view that the infections would peak in early April also informed our portfolio decisioning. So we actually spent $900 million in March buying bonds in Australia and overseas when credit spreads were moving dramatically wider. And that's basically what's come to pass, Paul. So we have seen new infections peak here in Australia at the end of March, early April. In the US, they peaked around the 10th or 11th of April. And in countries like Spain, Italy, the UK, France and Germany, we've seen peaks in early April. So the outlook is pretty promising in that context. Having said that, we're obviously worried about second waves, and we're focused on ascertaining in real time through those COVID-19 tracking systems how effective governments are in really flattening the curves.
Mm-hmm. So what countries have not peaked or reached peak infection rates at the moment?
The obvious ones are specifically countries that didn't contain with hard lockdowns early on. So we have seen in nations like Japan and Singapore where they had very slow growth rates, consistent increases over time in those growth rates. So early on, Japan and Singapore and Hong Kong and Taiwan were held up as the exemplars of high efficacy containment strategies, so areas where we didn't have exponential growth. But what we have seen is that in Japan and Singapore particularly, where they haven't actually locked down the population and sought to more or less eliminate the virus and get the reproduction rate, or the so-called R0, or it's also known as the REF, REFF, the reproduction number below 1. If you get it below 1, that means, Paul, if you're infected, you're going to transmit that infection in all likelihood to less than one other person. And 1 is the crucial threshold below which the virus will effectively die out. So the reproduction rate here in Australia is below 1. It's below 1 in New Zealand. So again, the containment strategies have been pretty impressively effective in the Antipodes. But in Spain and Japan, in Singapore and Japan, I think they were head faked and lapsed into a false sense of security around the slow early growth profiles. But we are seeing ongoing growth and a lack of containment in those geographies.
Yeah, it's interesting, I guess, the varying isolation rules that have been brought in by countries around the world, and I guess some of it, in my mind, has been questioning the social licence of the government and whether the people think the government have that ability to seriously impact on their lives. So it is interesting, but we are certainly seeing increases in some countries of the rates there. Do you believe that the isolation rules in Australia should be reduced given the fall in the amount of new COVID-19 cases?
Yeah, quite emphatically so. So, in addition to arguing in March that the June-July peaks and the epidemiologists' modelling and forecast was wrong, and that we'd have very, very early peaks, which would be a positive for markets. So I probably didn't, make that very clear. But we also hypothesised that once markets could see through the peak, we would get very favourable price action. And that's exactly what we've seen in April. As you know, Paul, we've seen a strong rally in equities, but a particularly positive response in high grade, so A and AA and AAA rated bonds that are direct beneficiaries of QE. In relation to the Aussie containment strategies, we also wrote publicly in March that the Prime Minister's 6-month business hibernation plan was totally wrong, and that the Prime Minister needed to pivot away from that plan and adopt a 1 to 2 month aggressive lockdown of the kind that we have embraced, and then crucially transition the economy back to a more normal growth path. We argue that on all the available data, the fatality rates for anyone under the age of 50 to 65 is, if you look at the South Korean experience, between 1 in 1,000 and 1 in 2,000 people. arguably even lower here in Australia. And so the virus doesn't really pose a mortal threat to most of the working age population. So our proposal in March was a hard lockdown of 1 to 2 months, crush the curve, crush the virus, try to eradicate it if possible, but thereafter let the working age population get back into their jobs and then continue to quarantine or protect those who are genuinely vulnerable, that is people over the age of 65 to 70, where the fatality rates are in the high single digits for the 70 to 80 cohort and in the 15% range for the 80 plus cohort. Our view was that the economic damage done by a 6-month business hibernation plan would be very, very far-reaching and depressionary. It would put Australia into the worst recession we had seen since the Great Depression, and that it would give us double-digit unemployment, and that the economic, social, health and human costs of a depression would actually far outweigh the costs of a modest number of fatalities that would be incurred if we did a hard containment followed by a return to a new normal. Now, when I talk about, Paul, a return to a new normal, what we mean is we maintain those social distancing practices, so we don't run around hugging and kissing and shaking hands. So you still have those mitigating behaviours, and we need to maintain those practices until we get widely available vaccines and or effective antiviral drugs. Two examples of those are hydroxychloroquine and remdesivir, which is the Gilead Sciences drug that seems to be effective against the virus. So this was a fairly contrarian view in March. The good news is, Paul, that whilst the Prime Minister wrote to me and said he disagreed with our view in March, he has pivoted fairly dramatically. I think on the last count, he has not mentioned his 6-month business hibernation plan for 3 or 4 weeks. And he has said that we will basically be looking to exit containment in about 2 to 3 weeks. We've seen a relaxation of restrictions in Western Australia and other states. And I think in May, we will see a substantial normalisation of business activity, which is crucial to prevent permanent economic damage and permanent job losses. And another hypothesis of ours related to this point has been that as markets see, firstly, the peak in new infections pass, but then secondly, economies exit hard lockdowns and return to these new normals, that will be a second trigger or a second regime change for some more positive price action.
Yeah, it's interesting. I think we're going to have to be very cautious, aren't we, over the next sort of couple of years at least, until a vaccine is created to deal with COVID-19. And unfortunately, such simple things as the handshake may be a thing of the past. So in terms of the current damage that COVID-19's done to the Australian economy, what's your view on the current impact on GDP and company earnings?
Well, it's complicated, and we have hypothesised something called a V-shaped recovery. By view, I mean VU. And what we believe will happen is we'll have that fast exit from containment, albeit still gradual, and it'll be, I think, a long time, as you said, 1 or 2 years before we're truly back to normal as we once knew it. And I think there'll be a sugar hit in terms of economic activity as the unemployment rate starts to normalise. So the unemployment rate was around 5% prior to the emergence of the COVID-19 crisis. The RBA believes it will jump up to about 10%. That seems reasonable. So I would probably say somewhere between 8 and 10% initially. And then it should drop back down. But I think that there will remain significant structural unemployment for the foreseeable future. So I don't see the jobless rate going back to 5%. I think it'll stay in the 6 to 7% range for quite some time, because I think many businesses are using this positively as a form of creative destruction. So what I mean by that, Paul, is the idea is in capitalism and markets, you have big downturns and they kill off unproductive firms or zombie businesses. We've seen that
cleanse the economy, I think, as we've heard economists talk about.
Yeah, that's right. So we've seen the virus, unfortunately, strike a mortal blow to very weak members of our community, tragically, but also it is killing off weaker members of the economy. So Virgin Airlines is one high-profile casualty. And I think you'll see more zombies like Virgin killed off So they won't be coming back, or if they do come back, they'll come back in a very different form. But equally, I think many businesses that were carrying excess labour or unproductive labour won't be necessarily rehiring all those positions. I think you're going to see far-reaching consequences on a sectoral level. So if you look at the commercial property market or the REIT market, I think that's going to be a disaster. I think you'll see a huge structural downward shift in the demand for office property as this synchronized global experiment in working remotely has profoundly changed the approach of many small businesses to managing their affairs. They won't need those offices. I know my next door neighbours in our office building have called us and said, do you want to take our office space because we're going to work remote from now on? I think it's also a problem for fixed income investors who have bought the debt issued by zombie companies. So a classic example was Virgin Airlines issued a $325 million senior bond on the ASX in November, and that bond is now being wiped out, issued only a few months ago. And so my dog is barking in the background. We have obviously also seen a lot of stress in the many bonds issued by GPT and other major commercial property players that face the risk of default. I think for the economy, though, more fundamentally, we have this really interesting dilemma. One of the corollaries of our argument that we don't need a 6-month hibernation and therefore we want to avoid an extreme depression and that we want to get business back online quickly in May, June, is that the government's fiscal stimulus looks entirely inappropriate at this juncture. The fiscal package, and the PM has done a brilliant job managing this. I should say, notwithstanding that, I advised the PM in late February that we would see a liquidity insolvency crisis coming. I wrote about this in the AFR. I advised Josh Frydenberg, the RBA, APRA. We warned them about all of this, and it obviously came to pass in March. And I think the PM has done a brilliant job managing COVID-19, but I think he was excessively conservative. So the 6-month business hibernation plan was far too conservative, and he underestimated the ability with which he would be able to contain the virus. The reason we knew the peak would be in early April was in our forecasting model. I asked my data scientists to build a model that conditioned off the experience of some of the leading countries, specifically off the experience of China and South Korea. And the experience with COVID-19 is that if you crack down aggressively and quickly, you can crush that reproduction rate. South Korea has been a particularly good example of that. And Australia's actually outperformed South Korea, interestingly, in terms of our experience. So what that in turn means is that if you look at it from the PM's view, in March he was thinking we were going to a depression, we're going to have huge unemployment, we're going to have to shut down the economy for half a year. And so he announced what has been the biggest fiscal stimulus globally of any developed country on both revenue and expenditure bases. And because of that, he was proposing to provide enormous support. But if you're going to come out of containment quickly, like we are now in May, then you don't need all that support. So I think it's going to be important for the government so that they don't burden future generations of Australians with massive amounts of debt and huge tax liabilities to service. I think we're going to have to pare back on the fiscal stimulus. So in summary, what I would say is I am cautiously optimistic. I think the short-term growth will be much better than people expect. I think the housing market will perform better than people expect. Our view on housing is that house prices will not fall precipitously. CBA is saying 10 to 20%, AMP is saying 20%, Louis Christopher is saying 30%. Our view is that house prices will either flatline or at worst fall by up to 5% over the next 6 months. But once the economy normalises over the next 6 to 9 months, our view is that the current housing cycle and the boom more precisely will continue. So house prices increased by 11% between June 2019 and March 2020. And we think this cycle will see total capital gains of 20 to 30%. And so we think we have another 10 to 20% of capital appreciation to come once we get out of containment and move back to the new normal.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the NetWealth website to learn more and get the PDS, which you should read before making a decision. Products issued by NetWealth Investments Limited.
You're thinking there, Chris, that the residential property will be the strongest area of the property market as opposed to office property. I think you've made a couple of comments there earlier.
Yeah, I think it's highly segmented. So I think retail will be very difficult as we've moved to more and more digital shopping. I think office will be a disaster. I think resi will be incredibly strong relatively, and in outright terms, I'm very, very bullish resi. And that's because in contrast to, for example, 2008, I mean, in 2008, Aussie resi only fell, so national house prices only fell 8% peak to trough. And in 2009, they were up in double-digit terms in respect to the capital growth they delivered. So Aussie resi actually performed really well in 2008. But in 2008, we did have fairly aggressive credit rationing by banks. They were very worried about a big housing correction. This time around, that is not the case. This time around, the banks are being actively encouraged to lend. They are proposing to lend. We have much lower interest rates. Interest rates have been aggressively cut as they were in 2008. And crucially, I think you're going to see much more forbearance by banks for those borrowers who do want to avail themselves of interest rate holidays. So we have seen, I think, about 9% of NAB's financials were released yesterday, and about 9% of their borrowers, resi borrowers, ask for 6-month repayment holidays. And so those folks will get interest rate relief for 6 months, and they're not going to be forced out of their homes. So I think that's really important. If you kind of marry that together, Paul, with us coming out of containment over May, June, economic activity normalising over the next 3 to 6 months, if you look at Australia's economy, yes, tourism and travel have been hit very hard, but there are more Australians who travel overseas than those who come to Australia each year. And so I think what you will see is a huge substitution away from offshore travel to domestic travel or staycations. And so I think tourism will be fine domestically. Education will be difficult as our borders remain closed for some time. But I think, iron ore prices remain elevated. Commodities have fared relatively well. We're going to have some big global spending program that will support commodity prices in terms of our key exports. So I'm fairly sanguine. I'm not saying it's going to be a massive boom economically speaking. I think it'll be a short, sharp recovery, but thereafter we're going to have more debt and the economy will look different. We'll have more unemployment. We'll have fewer zombies, and I think growth will actually be lower for a period of time as we kind of pay our way out of that debt.
Well, we've seen a significant amount of volatility in the fixed interest market. So how is the Australian fixed interest market holding up at present?
Yeah, it's been pretty interesting. Fixed income is such an important asset class to understand for investors, and I think for folks listening to this podcast. So there's basically 3 or 4 different markets. So I'll take each in turn. The government bond market really struggled in March. So Aussie government bonds intra-month were down 4%. AAA rated Aussie government bonds had suffered a 4% loss through about the middle of March, and then were bailed out by the government bond QE that the RBA commenced on the 19th of March. So they ended up the month about flat. We saw what we call the financial credit market. So those are bonds issued by banks. So they can be senior bonds, subordinated bonds, or hybrids. The credit spreads on those bonds blew out to the highest levels that have ever been seen. So to give you some hard numbers, the credit spread on a 5-year major bank hybrid, in January it was about 260 basis points over bank bills. In March it blew out to 840 basis points over bank bills. In the GFC it only went to 590 over bank bills. So we were very aggressively buying those securities in March, and that's paid big dividends. So we've seen hybrid spreads compress from 840 over bank bills to about 470 over bank bills today. And on those purchases in March, you're getting double-digit capital gains. Finally, the corporate bond market, there's 2 parts. There's the high-yield corporate bond market, and then there is the investment-grade market, the triple B or higher rated market. There has been zero liquidity in corporate bonds. This has created a huge problem, very different to government bonds where liquidity has been wonderful, and also in financial bonds, so bank senior paper and even the hybrid market. Liquidity was amazing in March. We saw daily turnover in hybrids jump about 100%, in fact more than 100%. So we saw individual days in March where we had more than 120 million a day of hybrids turning over. You contrast that with the investment-grade corporate bond market, Paul, here in Australia, zero liquidity. You would be lucky to see, 10 to 20 million across the whole market trade in a given day. There just wasn't a bid, and that remains the case. Yeah, that remains the case. So the corporate bond market is still extremely illiquid, and that's why you've seen huge increases in exit spreads, which, in many products cases remain in place. So dramatic, increases to 1%, 2%, 3% in exit spreads because there's no liquidity, and therefore nobody really knows what those assets are worth. And the likelihood is that the real valuations are way below the reported NAVs, and that's been our experience when we've looked at other corporate bond ETFs, for example, and we've asked those managers, where are you, having to sell your corporate bonds at when you get an ETF redemption? And the feedback to us has been that typically it's about 3 percentage points below the official NAV. And then finally, in the high yield bond market, we've seen massive losses. So globally, high yield fell about 15% in March. I should say, the hybrid market. So if we look at the data, just quickly, equities were down 21% in March. The high grade bank bond market was down about 1 to 2% in March, so relatively resilient. Hybrids were down about 6.3% in March. Our active hybrid ETF product that we run for BDS shares, HBRD, was down 4.5% net of fees, so we outperformed the index significantly. The high yield bond market was down 15% in March. And then the market that really got blown up badly was the high yield LIT or listed investment trust market on the ASX, where products were down 20, 30, 40, 50% and still remain really deeply damaged because they're all trading at massive discounts to net tangible assets. So it's really a tale of many, many different stories in fixed income. I think the interesting thing is in April, we've seen a massive rebound in financial credit. So in pretty much every portfolio I run, and I run about 20 portfolios across about $3.5 billion of FUM, most of that is for institutional accounts. Paul, we are having our best returns ever in history in March, and that is because credit spreads are normalising. So as I mentioned, hybrid spreads have come from 840 over down to 470 over, still well wide of the 260 level in January, and so therefore still very appealing, I believe. We're also seeing a big shift out of equities that used to pay high dividends like bank stocks into hybrids because those dividends are disappearing. In senior bond spreads, major bank senior bonds, we've seen spreads come in from 175 over bank bills to about 85 over bank bills. Subordinated bonds have been much more sluggish, so we still see some value there that is potentially interesting. But the corporate bond market, we haven't really seen spreads in Australia move at all. High yielders offshore has performed a bit better. The US Federal Reserve has started buying high yield, so I think that has helped that market. The LIT market, as I mentioned, is still very much broken.
Do you think we'll potentially see a spike in company defaults in the high yield space?
Absolutely, yeah. So we don't own any corporate bonds in our portfolios. I had 2, Coles and Seek, in January. I sold them both in January. We're 100% government guaranteed banks for the reason that banks are government guaranteed. And I have been arguing for 12 months that the high yield market is going to be a massive problem and a huge source of risk. If you read my AFR columns, I argued it could be the source of the next, GFC, and obviously it's played a big role in the COVID-19 crisis. And the reason being is a high yield bond is basically a company that can't normally borrow from a bank, that is paying a much higher interest rate to get a loan from a fund manager or a pension fund. So these businesses tend to be smaller, they tend to be riskier, and we believe there'll be probably 2 or 3 big issues in this market. The first is we think we're going to see a lot of downgrades of currently investment grade bonds that are rated triple B by Standard & Poor's and Moody's. into the high yield bucket. And high yield is anything rated below BBB. So we think that there's going to be mass downgrades from the BBB bucket into the high yield bucket. What that means is you're going to have much more supply in high yield, and you're going to see a lot of managers forced to sell those high yield bonds because their mandates don't allow them to hold high yield. And the high yield guys are going to have a much bigger opportunity set, but that supply would generally reduce prices. So that's the first negative. The second negative is I think you're just going to see huge revenue shocks. We're seeing it every day. You and I would know businesses where revenues have disappeared. That means they're likely to start defaulting on their debts. Now, if you're a high yield bond issuer, you're not borrowing from a bank. Normally, you're borrowing from a non-bank lender. And so the risk is that you can't service that interest, so you start breaching covenants, you're going to see restructurings. Now, whether high yield managers actually disclose these defaults, I'm not sure. We don't actually run explicit high yield portfolios. We do have one fund that can invest in a little bit of high yield, but it's tradable and liquid high yield. But I think you're going to see defaults across the world in corporate high yield. And then I think you're going to see losses. And Virgin Australia is, again, the exemplar. They were put into administration because they didn't have confidence that they could repay their debts, and the bondholders are going to get completely wiped out. And this was a bond that was only listed on the ASX in November last year. So a bit of a disaster, and I think you'll see more and more of that. I think the final insight that we've had to offer on this front is that if you look at the reaction function from governments, they've had two key focuses from a policy perspective. One is to ensure that they protect systematically important banks and businesses. So I don't think the government would let Qantas fail, and obviously they're guaranteeing the deposits of all the banks in Australia, so they're not going to fail. The second focus for governments has been on mums and dads, workers and SMEs. So I think that at those two ends of the spectrum, you've got your too big to fail companies and Main Street, which are really being protected and vouchsafed by governments of the world. In between, we have the mid-market. And unfortunately for the mid-market, which is normally the high-yield market, these are firms that are neither too big to fail nor too small to matter to politicians. And so hence you have a situation where effectively the government has given the finger or the bird to Virgin and said, go and sort out your own mess. And I think you're going to see much, much more of that.
Mm-hmm. Yeah, it is. It's interesting. There's a bit of moral hazard there, isn't there, in terms of who gets bailed out and who doesn't get bailed out potentially. Moving now to portfolio management, can you give us or touch on a short summary of some high-level changes you've been implementing in your portfolios over the last sort of month or 6 weeks? And do you think you've got more of a bullish or a bearish stance in your portfolio positioning?
Yes, I can tell you exactly what we've done. Basically, in January, we net sold $422 million in bonds. We built up cash. We lifted our weighted average credit rating to its highest level ever, AA-. In any leverage strategies we ran, we delevered those portfolios to their lowest levels ever. In February, we were neutral because we were still trying to figure out whether the pandemic would go global. But by the end of February, we were convinced that we would have this liquidity and solvency crisis, and we were convinced the crisis would necessitate extreme QE. Since April last year, I've been calling for QE in Australia. COVID-19 has obviously accelerated that. Really, frankly, what I got slightly wrong in March was it was really obvious to us, Paul, that we would have the mother of all liquidity and solvency shocks. And the only solution for central banks and treasuries was to go to extreme, unrestricted, unconditional liquidity support and QE. And we were telling the RBA, APRA, the Prime Minister, the Treasurer this in February. And we were getting kind of lots of nods and acknowledgements. But I don't think the RBA was on the same page. And it took until the 19th of March for the RBA to actually start QE. And by that time, all the damage had been done. And we were saying to them, listen, you can prevent the damage preemptively, or you can wait for the damage to happen and effectively see markets blow up. And that's what happened in the first half of March. So we expected QE in week 1 or 2 globally from all the central banks synchronized. We got it. Emphatically, QE synchronized globally, but it was probably weeks 3, 4, 5. And so we bought aggressively through March. I spent about $900 million, as I mentioned, buying at the wides in March and throughout March. And in So effectively, we had the best because we were not focused on corporate bonds or high yield. We didn't have any exposures. And because actually the biggest moves were in financial spreads. So basically the bank's senior bonds, their subordinated bonds and their hybrids. And we went limit long. So we bought as much as we could because the spreads on offer were the best levels we'd ever seen in human history, more or less, in recorded history. And then in April, huge buying, like basically once in a lifetime buying opportunity. And in April, we've just prudently taken profits. So we probably net sold 300-400 million in April. Spreads are still very attractive. We've had net inflows across our business over March and April, so we haven't seen substantial outflows. That includes, I should add, our insto mandates. So we run 20 portfolios, and so I think our retail funds have been fairly static. But we've had strong insto flows. I'm still a buyer at these levels, but equally, on positions that we put on in March where we've taken fairly aggressive profits. So I like the entry levels right now. Across most of our asset classes, they're pretty attractive, but we're really focused on liquidity pools. So we typically trade up to 50 times a day. We're typically doing $50 million a day per trade. On average per day. And we're trading up to $300 million a day, and we're focused on very high grade, typically A to AA rated paper that's often repurchase eligible with the RBA, which means that it's eligible for the RBA's liquidity facilities. And this is not a liquid, loans or corporate bonds. This is stuff that we can, hold for 3 months and then move on. And we proved that in March. In March, we stress tested our liquidity. So I would regularly go to ANZ and say, where's your bid for $500 million of my bonds? And they'd give us a bid every single time on the darkest days of March. And the transaction costs were absolutely acceptable if we had chosen to exercise that, which we didn't. Obviously, we were buying. So I'm pretty I'm bullish for my market. I'm not necessarily bullish global growth. I'm still worried about the tail risks. I'm worried about second waves. I'm worried about policy-making error. In the main, I'm nervous about vaccines. I'm nervous about immunity. But my central case is we can get immunity through antibodies. My central case is we do get effective vaccines within about 10 months, probably 9 or 10 months now. My central case is we do get effective antiviral drugs. My central case is that the world comes out of containment much faster than people assumed a couple of months ago, which is positive for global growth. And my central case is we'll be left with a lot more monetary and fiscal stimulus than we probably needed, which is positive in the short term. But I'm worried about things like geopolitical risks between China and the US. I'm worried about Trump tape bombs and Trump just making mistakes. And I'm worried about, policy-making error, which is probably our biggest risk.
No, very interesting there, Chris. Thanking you. We usually finish these podcasts with asking our guests for any personal investing tips you can share with the listeners. So do you have any words of advice or wisdom that you've applied in your own investment philosophy since you were young? And any specific thoughts that could assist listeners with navigating the current crisis we're dealing with?
The one thing that's served me really well for decades has been being contrarian, but being contrarian, there's lots of different types of contrarian. So I think if I kind of think about this out loud, you got guys who are contrarian who like just being contrarian, and they're posturing and they want to be controversial. One good example of that is if we go to housing. Steve Keen is consistently a perma bear on Aussie housing. It's always going to fall 40%. Whereas if you look at our track record, we said there'd be a boom between 2012 and 2017. Before anyone else in the market, in early 17 when prices were rising, we said we'd have the biggest correction in history, a 10% drop in prices. That's exactly, we got 11% fall in house prices between 17 and 19. And then in April last year when prices were still falling and no one had a positive forecast, we said we get a very quick rebound, a 10% increase in prices. That's what we've got. And we're contrarian again at this point in the cycle. Everyone thinks the housing market's going to collapse, and we're saying it's going to flatline. But I think it's important to be contrarian on an evidentiary basis. So if you are a very empirical person, if you're highly analytical, if you're not emotional, and I think so. The key takeaways are for me if you be a contrarian, if you can really actually fade the rest of the world. And what I mean by that is, as an active manager, every position I have is more or less me saying I'm right and the world's wrong. That requires conviction, but it also requires intellectual humility to understand when you got it wrong and to be able to reverse out of that position and cut the losses. And that's not easy to do. In our business, I've got 23 staff, 11 analysts, 4 PMs, 3 PhDs, a lot of really, really smart talent, and we are just constantly engaged in the search for the truth. And so we are very data-driven, very empirical, and when the data tells us we're wrong, we run for the hills. So I think be contrarian, and then also stick, once you have the analysis and the data and the research to support your position, you got to stick to your guns. That's the other message message I would deliver, and the lesson for me personally is every single time in my life, you always reach this certain crucible, this inflection point where everyone in the world is saying, Chris, you're wrong. This is bullshit. COVID-19 is going to be 70% of all people in Australia are going to get infected. We're going to have tens of thousands of deaths. And markets are in free fall. Credit spreads have gone to their highest levels ever recorded. And if the data stacks up, you just got to stick to your conviction that you're right and the rest of the world's wrong, and it pays massive dividends. But that requires a lot of unique insight and a lot of unique research. So I don't think everyone's in a position to do that, is also my advice. So in that respect, you might want to delegate.
No, great advice there, Chris, and easier said than done. A lot of what you said there, but you certainly need to be brave. You certainly need to have evidence and know what you're doing. And I think, as you're talking there, I'm thinking to myself, it's really about sticking to your long-term investment strategy. Make sure that you have comfort in that, and don't make knee-jerk decisions just based on what you've read in the news or seen in the newspapers today. So, Chris, thank you again for your time this morning and very insightful comments. We really appreciate it. And wishing you and the Coolabah team all the best during this difficult period.
Thanks for listening to this episode of the Net Wealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.